Welcome back to the program. Ayodeji Ebo, the head retail investment at Chapel Hill, Denham, is joining me right away. Hello, Ayo. Welcome to the program. Quite a while. How are you?
Thanks for having me. Yeah, I'm doing good.
Let's get
Thanks for having
started.
me.
Let's get started. The surprise announcement was on yesterday after the NPC. In fact, I had an interview with Johnson Chuko, the CEO of Carry Asset Management, on Monday, wasn't it? And I was asking him if the market was expecting any kind of surprise around the rates. And I think I also remember I asked him around FX movements and so. But the CBN surprised everyone yesterday with that announcement stopping forex sales to BDCs. What's your own analysis of this? What do you think of the policy? I have read newspapers this morning, I think it's The Guardian, that said in a rare move or in rare courage. So, courageous or not?
Okay, thanks. I think, firstly, this will seem to be the first time that a major decision will be taken regarding FX at FTC meeting. And so for most people, we've seen most policies have been taken outside the MPC meeting regarding FX. We saw this we saw this action in 2016, and within a year it was reversed. But I think it was almost expected with what we're seeing within the BDC space. So when you see, based on the numbers that the CBN also revealed out yesterday, you look at it at about spending about $110 million weekly, and spending to over 5,000 BDCs, and still there's a bit of scarcity and high gap. Most of them are not selling at the official rate they're supposed to sell to the customers. So I think what the CBN effectively has done, which is a very bold step, is to see get everything within its control. So it may be easier for them to be able to trace and control banks compared to controlling over 5,000 BDCs. But the success of this, while it has its pros, it also has its cons. The success of this will be based on the implementation. The first thing we would also like to say is that, one, it doesn't take the BDC, effectively take BDC out of business. Most of them source dollars from autonomous sources. So we've seen as of last year, if you check, I think the CBN sold close to about $10 billion to the BDC. But this year they sold just less than, I think, about less than $3 billion, which means that there's also a major dependence on autonomous sources. So they will still continue to be in business, but doesn't mean that what is just going to happen is that CBN won't be selling directly to them. But if we look at the likely implications, so we would see that a lot of those that require cash dollars, because from what CBN says to them is cash dollars, and there's also the inflow dollars. So if the CBN is able to ensure and enforce it that the banks are able to not simplify the process, now we have technology and they can be able to ensure in terms of time of providing this. CBN has released about $200 million as of yesterday to also increase the confidence within the market. So I believe that we may see some knee-jerk reaction in the immediate, but in the medium to long term, if this is properly implemented, then we'll begin to see that convergence of the naira within the parallel market. So that's my initial view. Then I would also like to just add that to make this also very effective, the banks then also want to increase the limit on naira cash, because for most people, when you have the $100 monthly limit, most people revert the black market to source for additional dollars for their obligations. So if that can also be taken care of, it will reduce pressure, and we may begin to see the convergence of the naira within the official market.
How about for people that say, because I've heard a lot of commentary since yesterday, people that say that this is the right policy at the wrong time, or for people that have also said, why is the central bank doing this at this time? For people that also say better late than never. Where do you stand?
So I think it's better late than never, because when you see the amount that is being sold even to the to the BDC is significantly higher than what the CBN sells even at the official window, the investors and exporters window, where they should have also been receiving more. So what this will effectively do, because we're not saying in terms of the unethical practice going on will be totally erased, but now it will be minimized because it's within a control system. We would see, what we would see is that there would be enough, the CBN should increase the supply at the investors and exporters window so that there will be less reliance on other sources. So once we begin to see that, there will be more confidence while the CBN also continues to work on how we can be able to attract more FPIs. Because the FPIs, most times when you look at the analysis, are those that provide that liquidity over time. So once you see the capital and production reports also just came on this one, once you see that FPI is also reducing, it puts a lot of pressure even on the CBN. So as we progress, as we see that confidence also return, then we'll also begin to see a bit of more stability. But for this to, I think I will stand with those that say it's better late than ever, because yes, even if the CBN is going to reverse on this, there needs to also be better control, because when you look at the situation of things, it's like they're just giving what some call promo $3, they give to at a certain rate, which is around the 393, and people are selling at the 500. So for those that are even supposed to get the CPA, get it at very control level, most of them don't get it at that level.
I also like the fact that you said earlier on that the CBN is not selling FX to BDCs, but that doesn't mean that the BDCs will not be in business. Do you see a shrinking of the number of BDCs now as a result of this policy? The central bank governor did announce yesterday that we have over 5,000, and in fact, a lot of people are still looking for the licenses for BDCs. You can even see one owner owning like 5 BDCs or 10 BDCs just for corrupt purposes, or, you know, for that purpose of round tripping. So do you think that this will shrink the number? That's the A part of the question. The B part of, yeah, okay, go ahead.
No, please, you can have it out.
Okay, no, just go ahead with that. And after that, I would take off with the other question.
Okay, so I think this is very obvious that we would see a major reduction in the activities of the BDC owners, because, like you rightly said, there are some that have more than one license. So it means that once this cheap way of making profits has been taken away, then it means that there will be less interest, because they were set up for a purpose. They are supposed to also, in terms of sourcing for their dollars. So, but what most of them wait for is they wait to just get the allocation. And when you even do the math, if you get $20,000 in a week and you are able to sell at the parallel market, that's almost like 2 million naira per week without even thinking, without doing anything. So I think now it would be those that are really concerned, that have the interest to remain in the business, that would sustain it. But I know most of them will also be trying to see whether this will be reversed very soon.
Has anyone spoken to you, like any BDC owner spoken to you? What are the feelings that you're getting from the marketplace? Just give me any clue.
So it came as a major shock also to them, because a lot of them are also done a projection. And when you also check the market in terms of the market price of buying an existing license, it's very significant. I don't want to put numbers on there, but very significant. And some might just have acquired their licenses. And now with this new policy, it means it looks like it's a bad venture, and they will lose a lot of money, because you have to source now from autonomous sources for you to be able to make money and recover and be profitable. So it's going to be also a major blow to them, but at least they've seen this is not the first time. It happened in 2016. And I think what we may just, the difference now is that the banks are a bit more prepared. So when you look at the Naira for dollar policy, in terms of the implementation, they were able to set up a desk very fast, and you can see a lot of the marketing. So what I think we should expect to see now is that CBN should just try to continue to persuade the banks to see how they can increase the disbursement, the application, automate it. And yes, I know there has to be documentation, but this is the era of technology. So if people if they can scan and they can verify your documents even online, you don't have to get to the bank. I think it's also a very, very good one, and will also help reduce pressure on the market, because you also need to recall that there's still, when you check the ineligible list, maybe as we progress, as the CBN has more buffer, as the results improve, they may also want to review the list so as to reduce the demand that we have in the unofficial market. Because this demand continues to be there. Or if you look, for instance, the average person I want to import a Tokubo car, most of them will go to the black market to source for dollars. So some of this demand will still remain there. So how can the CBN just come up with something to reduce the demand over time, so that confidence is restored and there's liquidity denied? Then we'll begin to see a bit of convergence, which will provide confidence for foreign investors.
Do you think that this move, it's in the right direction towards the full, liberalization of our FX markets? That's the A part of the question. The B part of the question is, I'm going back to the BDCs, because if we see the sources of FX to the BDCs, we have from CBN sales to them, we have from remittances, and we have from the open market. The CBN has closed that tap now. So do you think that from the other two sources that it will be sufficient for BDCs to still continue to operate? Because I can imagine for a BDC operator now, for a BDC owner, what permutations and combinations they will be doing right now. CBN has stopped the sales of FX. What should I do? Can I get enough money from remittances? Can I get enough money from the open market? So those are the two questions.
Okay. Yeah. Okay, thanks. Starting with your first question. So what we can see that is happening is removing the different rates. So we've seen that the CBN has collapsed the own official rate to the investors and exporters window. Now, the BBC rates have also been taken off. So we would say it's a move towards the convergence. So what we would also expect is that and the investors and exporters window, which is now the reference official rate, depending on the CBN should look at depending on the demand and supply. So and should effectively implement the managed flows, which is the policy FX strategy that CBN is pursuing. So based on that, it will not the devaluation or depreciation will not come at once. So based on the demand and supply, we should begin to see a move. Yes, when you look at the forward rates at the investors and exporters window of the FMDQ, so it suggests that we would expect that there will be a movement as we progress. By the time you take the 3 months forward and you take the 12 months forward, you would see that there would be an adjustment towards that rate. Coming to your second question on the BDC. So now it's like coming to the drawing board. The free money, or the quote with the economics we call the abnormal profit that you just make before, now it's off the table. So it's really going to affect their cash flow, because their margin would now be really very thin. So it's now for those that are really in the business of BDC based on the interest that would remain, because now you have to work before you be able to earn a return. So it's really going to be a tough time for the BDCs, and we expect that over time the number of BDCs will shrink if this is sustained and prolonged, because it may not make any commercial sense for a lot of them to be in business, given even the cost of doing business has continued to escalate even in the country.
How do you think that the CBN should go about minimizing the Herculean task faced by customers at the banks in search of FX for their different purposes? The central bank governor did read a Riot Act yesterday. In fact, he was so vehement. You need to see his face yesterday, also giving Nigerians the phone number of the CBN and I think the email to report banks that do not do what they're supposed to do. So how do you think that that Herculean task can be breached? Then the final question before you go, what do you think about the outlook of the Naira in the mid to long term? Because most analysts are saying that the short-termism effect is that the Naira would have pressure. There'll be pressure on the Naira. So gravity, you know, gravity, what goes up must come down. So what's the outlook of the Naira? As well as what do you think it's the natural value of the Naira with this policy? Or what will be the natural value of the Naira with this policy in the mid to long term? I did say short term, mid to long term.
Yes, I think starting with your first question, which is on the implementation, and so I think what the CBN would do is just emphasize on its close examination. There's what we call the banking and mystery shoppers that you put in some independent people going around to see how this policy is being implemented. So that would also put the banks would also ensure that the banks are also complying. But with you see with the crypto line that's also been set up. So depending on the feedback, so when they give this complaint, how does the CBN ensure that they follow it through and it's sorted out so that it gives confidence? And once and there's also a sanction for in any major default. So once they begin to see that this is here to stay, and in terms of sanction or fines, the CBN is doing this, and you would see that everybody would adjust and would begin to enjoy the benefits of this, because it's a more controlled system in terms of when you even check the number of branches, and that will reduce a lot of the abnormalities that we were experiencing before. And in terms of the outlook, like I mentioned earlier, would now, based on the CBN's FX strategy, which is a managed flow, so we expect that as the pressure intensifies, we expect to see an adjustment, a convergence. So we're expecting that there will be an appreciation from the unofficial market moving towards the official market. While from the official market, there's also a shift, because when you look at this, yes, we can look at different ways of valuing the Naira, the PPC, purchasing power parity, looking at interest rate parity. Yes, you see that it looks a bit undervalued, but it's also depending on the demand and supply. So if based on the demand that the World Bank has what the World Bank has requested, that we should ensure a convergence, and we're able to get the $1.5 billion. And I know also the federal government is also considering the option of also raising Eurobonds. So if those two are successful and they can raise about $5 to $6 billion, it gives even the CBN more confidence, and even for the foreign investors would see that confidence that would also come, which would attract more inflow, and as a result, they would see an appreciation. But I think the single factor, the underlying factor that needs to be addressed is diversifying our FX inflow. As long as we continue to depend just on Naira, on oil, then if there's any major shock, then we'll always come back to this table. And that is part of what is giving that expectation that we'll continue to see an adjustment in the medium to long time of the Naira, because the cost of our FX inflow is not diversified.
Thank you very much, Ayo, for speaking with me this morning. Thank you for your insights. All right, I've been speaking with Ayodeji Ebo, who is the head retail investment at Chapel Hill, Denham. Let's quickly take another break, and when we come back, Dr. Hassan Mahmoud, the Director of Monetary Policy Department at the Central Bank of Nigeria, will be joining me here to talk about this 10-page communique. What happened yesterday? The devil behind the details. So is it the devil in the details or what? Whatever it is, we'll be looking at that when we return from the break. So do join us on all our social media platforms. We'll be right back.
The committee thus decided on, by a unanimous vote, to retain monetary policy rate at 11.5%. In summary, MPC voted to 1. Retain MPR at 11.5%, 2. Retain asymmetric corridor at plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 27.5%, and 4. Retain the liquidity ratio at 30%. All those social media messages going around are all fake and indeed are fraudulent, and the CBN is currently doing everything possible to trail those perpetrators who intend on creating problem to create banking system instability. We will, by God's grace, unravel who they are, and we will announce them, bring them to the public if we find them. But I want to say that, and I repeat, that the strategic health of the Nigerian banking industry remains very, very strong. For instance, at today's meeting, data was provided to Monetary Policy Committee members, and I will say we reviewed the financial soundness indicators of the Nigerian banking industry. For instance, capital adequacy ratio averages 15.5%. For the national banks, they are only meant to have just 10%. For the international banks, those operating with international licenses, they are supposed to operate at 15%. If we have an average of 15.5%, we believe that this capital adequacy, the Nigerian banking industry is well capitalized and can meet any shocks if they arise.
All right, welcome back. As you can see from the card there, Dr. Hassan Mahmood, the Director of Monetary Policy Department at the Central Bank of Nigeria, is with me here at the table. Dr. Mahmood, welcome to the program.
Thank you for having me.
Let's get started. The 10-page communique is not as much as, because I counted it now at least since this year began.
Yeah.
I think, was it March? Oh no, was it January? There was more than this one is just 10 pages. Okay. But we'll look at the details, the 10. I want to ask you first, what has changed in the last 8 weeks? The last meeting was in March. Yes, between March, the end of March till yesterday. What has changed? Is it same old, same old?
Well, it's not same old, same old.
Okay.
I think generally we are seeing some subdue in some of the shocks that were coming in from particularly the third quarter of 2020. We saw the resumption of some normalcy by the fourth quarter, but that consolidated by the first quarter of 2021. So numbers around inflations, numbers around GDP improved, numbers around capital inflows or capital volatility also improved, numbers around global performance of the international financial system also improved. So we see that coming up, and we see the more reinforced optimism in terms of the global growth numbers, which will also dovetail to the performance of the domestic economy in Nigeria in this case, including trade. Now, the projections of trade at the fourth quarter of 2020 has actually surpassed the pre-pandemic era. So we see those stabilization factors coming in. Regardless, there are still uncertainties in some quarters, but generally we're already coming out of the woods. That is the recession that we had in the second and third quarter of 2020.
Is it that there's an arrangement or there's a meeting amongst the central banks of Africa or in Africa right now, majority of you to be on a hold stance? South Africa held its rate steady last week, I think 3.5%. Some other central banks, I'm not saying some others are not tightening as a result of, they're saying restrictions are reducing in many parts of the world and all of it. Is it that there's a meeting you all are in that will analyze the African economy and say, okay, guys, let's hold?
I think all of them are using, I can say, informed methods or approaches, standard approaches to look at things objectively and according to, the economics and the finance and the politics and all those, theories together to see that there were a lot of injections that came into the economy to reflate most of those economies. A lot of them have lagged outcome effects in the sense that it takes a while, 2, 3, 4 quarters before you start seeing those things, the expected outcome crystallizing in those economies. We've done that. We've done those huge injections, and then it is time to wait to see what is the outcome of that. Are those working before you start rushing to change those policy tools? In most of the economies, there are quite a lot of signals, both advanced and emerging market economies, that those injections, both fiscal and stimulus, are yielding some expected outcome, but very slowly. So it's important that you just watch, slow down, consolidate on what you have, and keep seeing the new results before you start making any drastic moves, so that you don't distort those little or marginal gain that you're already seeing. I think that's what is informing why everybody is just waiting. There are other tools that are being used apart from the monetary policy rate itself to make some administrative adjustment within the economy. But the key parameter everybody is looking at is there any adjustment in monetary policy rate?
Has the central bank run out of those tools?
Well, we've not really run out of the tools, but I think we've used the tools we have now to their prime. Monetary policy tools are not like structural tools you use for, long-term economic management issues. But at this stage, and the potency of monetary policy tools within crisis, during the crisis period, is also limited. When you overheat the economy, if the fiscal side or other structural parameters are not coming up to speed with these monetary policy short-term tools, then if you overheat with monetary policy tools, then you overheat the outcome of the economy, and that will be more distortionary in the medium to long term than when you have to complement what the fiscal side is doing in terms of infrastructural issues that are supposed to support the growth drive, other supply indicators that are supposed to help in bringing production to the market, so that you don't just start adjusting price parameters thinking that will bring down the price when the supply side is just not coming on board.
From the central bank angle, do you think that you all have supported the market with the monetary tools, at least in the short to mid-term, at least in the last 1 year, since the monetary policy rate has been left at 11.5%? Do you think that that has supported the market sufficiently to attain stability and to also ensure that banks are lending to Nigerians?
I think from the start of the crisis, we adjusted monetary policy downward. That's an indication of expansionary monetary policy. And outside of that, there have been a huge volume of monetary policy injections in terms of monetary policy stimulus, complementing that of the fiscal. So that has been expansionary. The unconventional monetary policy tool has also helped significantly in pushing some of those parameters, because like I said, monetary policy tool efficacy is also a lot limited when there is crisis. And that was this period we experienced in the last 2 to 3 quarters, and which we are still just trying to pull out of. So indeed, yes, monetary policy tool has substantially supplemented or contributed, supported the marginal or moderate recoveries that we are seeing now, particularly in terms of real sector performance and the financial soundness position. You could also see that the resilience of the financial system, which could have also been a very major crisis to compounding the economic growth crisis we are having, if the financial system were also allowed to go under or have a major systemic problem. So the resilience of the financial system to continue to support, if we are doing interventions and all the stuff, we are doing them through the commercial banks or development banks. If those ones are not stable there, then you don't even have that transmission channel to get to the consumers and households and firms in using your monetary policy tools of those monetary stimulus packages. So I think in general that there's been a complementarity between those development in terms of driving the growth outcomes that we're getting now.
What are the long-term policy goals of the CBN? Especially around inflation. I know you have a target for yourself, 6 to 9%.
Yeah.
But it's not been met. Inflation is at around 17.75%
Yes.
now. So what are the long-term policy goals? That's one. The second question is, what kind of inflation rate will the Central Bank of Nigeria be comfortable with? Not the 6 to 9%, because I don't know when we will get to that.
Yeah.
There are a lot of aspects that we need to have in place, or a lot of things we have to have in place to make us get back to that 6 to 9%. Yeah. But what kind of inflation rate can the Central Bank of Nigeria be comfortable with now, vis-a-vis the policies of even yesterday on the FX side, vis-a-vis the production gap, the current account deficit which we have, and some other factors? So what kind of inflation rate can you be comfortable and saying, okay, I think we're on the path to recovery?
Yeah. That will depend on the economic conditions, how they change, and how fast they change. Okay. However, it is important to say that the long-run goal will be stable prices, low and stable prices, so that can drive the expected growth we are looking at.
What
so
is low and stable prices
well,
mean? That's in fact the cocoa of what I'm asking.
Yes.
What will be comfortable low and stable prices?
There are sometimes you need some level of price movement upward to stimulate growth, to stimulate supply. Mm-hmm. And there's also sometimes that when you see that the demand side is stifled, you need to bring down those prices so that the other guy was talking about the purchasing power parity, so that the power of spending, has, because inflation erodes that welfare effect or that income effect that you get in terms of your earnings and what it can buy, the purchasing power. So if you are in that situation where there's excess of demand and then the supply side is being stifled, you can't start asking for prices. You want prices to go up so that it stimulates that supply side, because the demand is there to push that down after a very short period. But the general goal is just to have a low, stable prices, because even if you have low prices and it's highly volatile, business projections or business plans cannot be executed easily, particularly both the financial system and even outside of the financial system. So you can say single digits inflation number, but that will not be static, like, oh, we want 5% this month and then we'll have 10% this month. But if it's able, because the mandate is to have stable price stability conducive for economic growth. So it has the flip side. Is the price numbers conducive for growth? Right now it's not conducive for growth. So we need to be working towards bringing that price number down up to the single digit territory that we're looking at. Now, and we also need to compare that with other economies that are your competitors within the trade sphere. So you see that disparity in your inflation numbers, and that will also affect the attraction of inflows to those your economy, because everybody is looking at your inflation numbers against your policy rate or the interest rate that runs in those economies. So we also need to be looking at those inflation numbers compared to our policy rate or the rate of interest within the economy. So long as that is narrowing, we want your rates to be above your inflation numbers so that you have positive real interest rate to attract whether domestic or foreign capital. If
the monetary policy rate at 11.5%, will you still say that, at least with the central bank these days, an expansionary rate, that's you all are on an expansionary drive, that means you are dovish, you've taken a dovish stance at 11.5%?
You see, you can look at it from two sides. If you look at it from the financial sector side, or the banking system side, and what we are doing with CRR, special bill, DCRR, and stuff like that, you see that there are kind of some tightening within the banking sector. So from that side, it is like tightening, to not to allow excess liquidity to, compound inflationary pressures that we're having. But if you look at it from the monetary policy side, for the fact that you reduced rates and you kept it at that reduced position, and you're also making some injections, huge injections into the economy, is still largely expansionary monetary policy to drive growth recovery. Maybe when we get to for the advanced economies like the US now, they are already making indications that by the time they get to a particular level of growth and employment, they are going to adjust their rates. They start
crying right
pulling
now
back.
That inflation is high.
It's high, over 2%.
Yes, about 5. Okay, yeah, 5.4%.
Yes, 5%.
Yes, 5.4% inflation.
So you
and
see that, yes, they should be crying because,
because it will erode their dollar, which is the reserve currency.
Yes, and it's also going to have impact on us when they start normalizing or tapering on this asset buying that they are doing to inject liquidity into the system. If they stop, because of the premium, the risk premium globally, you find that investors that are already in our country now or in other emerging market economies will start, carrying back their investments to the US because of the, the stability and the assurances and the low risk premium of those advanced economies. And that will have pressure on our exchange rate, pressure on our external reserves, and you start seeing issues around depreciation. And when we cannot adjust that fast, then we start doing devaluation.
I don't know if you answered the question around the long-term policy goals.
Yes, that's what I said. The long-term policy goal is low and stable prices.
Okay, so at that point I came in and said, and asked what is actually low and stable prices. Okay. Let's take a look at this area, which is this MPR and liquidity ratio, CRR. I want you to really explain to Nigerians that are watching now the importance of this rate. Explain it to that woman in Okari right now. Explain it to that young man in Onitsha, and why they should take particular interest whenever you and your colleagues meet.
Talk about this.
Yes. In simple terms, don't give me, break
yes,
it down.
Yes.
Don't look for those technical economic
No, I will not do that. But it's also going to be a big task, but I'll make an attempt. Yes, I think you have softer languages to deal with that, given my own background.
Just say your own,
what is
then
important is,
explain.
The MPR, the monetary policy rate, is supposed to be the anchor rate on which other interest rates are supposed to build, because they call it risk-free rate, the rate at which there is no any risk. And so that will be the 0 point where other banks, because that's the rate between the central bank and the banks. And from that rate, the central bank build their lending rate. So any adjustment on that rate, or certain risk variables, is supposed to feed into the money market rates and also the commercial bank rate in terms of lending. So if you adjust that rate downwards, we expect that to translate to the cost of lending, or the lending rates, whether prime or maximum lending rate, and that should feed to increasing credit in the economy so that people can have access to what we call cheaper loan. The liquidity ratio is between the central bank also and the banks, and this comes on the platform of the role of the central bank to manage the liquidity in the system so that that liquidity does not impact on the inflation numbers. So when it is the proportion of the commercial bank funds that is kept with the central bank at any particular time. If we increase that liquidity ratio, it means that the proportion of the central bank's liquid asset that we'll be holding will increase. That means there will be less money with the banks to play around with. And when that happens, you start seeing rates going up in the money market. If we release that to the market by reducing that liquidity ratio, they have more money in the system to also online to the customer. So the general public should be looking at that from that perspective. And then if you look at the last one, which was the CRR, which is tightly related to the liquidity ratio, is also the holdings of the central bank of those proportions of the funds that are with the commercial bank. All these are to manage.
For example, if there's 100,000 naira, the CBN will hold 27 naira.
Yes,
27,500 naira.
Yes, of it. Yes, with us. Yes, in case of some issues. But we have also made provisions now, because these are dictates of economic conditions, where even though CRR, the banks can also assess it. You know, we did the DCRR, and also where banks can, if they need those funds, because they are just idle funds with the central bank earning nothing. But it's better to stay here than leave it in the market there for them to be hitting the exchange rate market or doing other arbitrages that will distort money market rates. So if those banks have projects in the real sectors which have already been identified and there is guideline for you to assess that, they can come to the central bank and take proportion of that to online for those critical sectors that we know are important to drive these growth targets that we have for these post-pandemic initiatives.
Okay, I think it's simple enough.
I think.
Yes, I think you tried.
Yes.
Yeah, you tried to simplify it. Yeah. Now, as we wrap up the program, what other things do you want Nigerians to take away from this communique? The CBN governor said quite a lot of things here. In days to come, we would still look at it, not from me, from independent sources.
Okay.
You know, so that we'll critique it
yes.
very well. What other things do you want Nigerians to take away in the last 1 minute that we have?
I think the most important thing is, you know, because a lot of analysis come before MPC meetings and post-MPC meetings. I think what is important is for the general public to know that monetary policy decisions are not based on sentiments. They are not just based on, like you call media trial or something. They are based on core statistics. They are based on, you know, reasonable expectations of favorable outcome for the economy, including driving employment, because that's what whether GDP is growing at 50%, so long as it's not creating jobs, so long as the money that people are having in their hands has no value, so long as they don't have access to foreign exchange to do some of the things they want, they just feel that the economic system has failed. So what is important, the takeaway is that decisions of the monetary policy, one, are geared towards achieving these social benefits for the entire economy, including the impact on individuals and households. It's not just theory and CRR and MPR and stuff like that, but how it will impact on the economy, reduce poverty, increase employment rate, and make the standard of living of people better.
Okay, I think we'll leave it at that.
All right.
Thank you very much, Dr. Mahmood. I've been speaking with Dr. Hassan Mahmood, the Director of Monetary Policy Department at the Central Bank of Nigeria. We've been talking about the MPC decisions that was read out by the Central Bank Governor on Tuesday after the meeting. Thank you all for joining us today. Please join us again tomorrow. I will be here, God willing, 11 a.m. to 12 p.m. on this channel. But the best you can be, but that change that you want to see. I am Nancy Naji.